In 2015, Harley-Davidson, the motorcycle maker, reported declining sales and declining profits, yet their return on equity, a common measure used by investors to determine how their investment is performing, increased by a remarkable 12%. Unbelievable. Return on equity, computed by dividing net income by total stockholders' equity, is the single measure that summarizes the financial health of a company. Return on equity, ROE, can be interpreted as the number of cents of net income an investor earns in 1 year by investing $1 in the company. As a very rough rule of thumb, ROE consistently above 15% is a sign of a company in good health. ROE consistently below 15% is a sign of trouble. Harley's return on equity increased from 29%, very good, to 41%, unbelievable. And the obvious question is, how did that happen? To answer that question, let's think for a moment about what a business does. A business obtains money to purchase assets. With those assets, the business intends to generate sales. And with those sales, the intent is to generate income. Well, almost a century ago, an accountant with the DuPont company named F. Donaldson Brown came up with a systematic approach to identifying general factors causing ROE to deviate from normal. This approach uses ratios to break down ROE into 3 components as shown here. For each of the 3 components, profitability, efficiency, and leverage, there is one ratio that summarizes a company's performance in that area. These ratios are as follows. First, return on sales is computed as net income divided by sales and is interpreted as the number of pennies in profit generated from each dollar of sales. The second ratio, asset turnover, is computed as sales divided by assets and is interpreted as the number of dollars in sales generated by each dollar of assets. And finally, the assets to equity ratio is computed as assets divided by equity and is interpreted as the number of dollars of assets acquired for each dollar invested by stockholders. You can see that the leverage ratio measures the proportion of assets financed by equity holders. The efficiency ratio measures how well assets are used to generate sales, and the profitability ratio measures the amount of income generated by sales. Those 3 ratios mirror what a business does. It obtains financing to purchase assets, deploys assets to generate sales, and generates income from those sales. Now, in the case of Harley-Davidson, we see, comparing 2015 to 2014, that while profitability was down a little and the company was a little less efficient in using its assets, the big difference relates to the company's leverage. The proportion of assets financed by debt holders increased dramatically from 2014 to 2015, indicating that shareholders received a much larger return for their smaller relative investment in the firm. And now we can ask another series of questions. Why did profitability decrease? We can look into that question by common sizing our income statement to determine what expenses might have increased disproportionately. Why did efficiency decrease? We can look into that question by analyzing the efficiency with which individual asset classes were used. And we can inquire as to what happened on the balance sheet relative to our debt holders and our shareholders. Now, if we did this, we would find that the company borrowed a lot of money and used that money to repurchase shares of its own stock. Both of these actions would result in significantly increasing the company's leverage. The big takeaway here is that what a company does, the significant decisions they make and execute, can often be tracked through the financial statements using ratios. The financial statements don't define the business. Instead, they reflect the results of decisions and actions taken by management. We can see the results of those decisions and actions if we know where to look. The DuPont framework provides us with directions as to where to look.